What is up, ladies and gentlemen, boys and girls? Welcome to the Monday Market Update Special Edition. What the Fed and what the Fed indeed. It has been a roller coaster since we last saw you. If you guys have any questions about what's going on in the market, about what's going on with the Fed, what to expect, how that affects you, how it affects me, maybe if you're concerned, feel free to drop those in the comments. My name is Sean Grapevine. I'm Vice President of Product Strategy here at UMortgage, and I am joined today, as with most days, the one, the only, Matt, the mortgage guy, Gougé.
What is happening, Sean, today? If you like action, you like Friday and today, because there's action in the mortgage market, which means action in the real estate market, and a lot of fun stuff to talk about. Looking forward to it, brother.
Me too. I can't get enough of it. Up, down, sideways. Well, up or down, it gets me going. You know, there is whenever there's volatility, whenever there's chaos, whenever there is concern, whenever there's fear, there's always opportunity. I've learned that in my days in sales and outside of sales, that this is actually an opportunity for everybody. Do you agree?
I agree 100%. And it's going to be an interesting time, because generally speaking, the general public consumer sentiment kind of lags, in my opinion. Like, rates are down. There's going to be this small window of opportunity for people to go out there while there's still a reasonable amount of inventory and get a new place, slap a nice interest rate on it that's probably between 0.5% to 5/8% lower than it was just a week ago. But that window of opportunity will close. And when it's just about to close is when everybody starts flooding in, because they, heard their neighbor or their coworker or somebody went out there and they're like, I didn't realize you can get a 6.125%. So it's going to be fun.
Yeah, we can just dive right into the numbers. We can dispense with the small talk, the chat, the personal interest stories, the banter. It's time to have the rubber hit the road here, because it's been, like you said, an alarmingly fun for some week in the market, unless you happen to own any stock. But that now they're on sale, so load up while you can. You'll see here that these numbers are from Friday, August 2nd. So the average rate shown 6.429 on conventional, 6.287 on FHA, 5.87 on VA, your and my personal favorite loans. And this doesn't even take into account what's happening today. I mean, a lot of our lenders are taking a little longer to release their rate sheets. I've seen the 10-year was as high as 3.72-ish, 3.79 even, as low as 3.65. It's been already kind of a crazy day. Brings me back to the good old days.
Yeah. And, for anybody listening who's wondering what the heck we're talking about, we've said it on here before, but if you haven't heard it, the way mortgage interest rates work, when there's bad news in the economy, the unemployment rate is up to 4.3%. The jobs report came in much lower than expected. That type of stuff translates to better mortgage rates. So if you're looking for better mortgage rates, for a home loan, and we get jobs report and unemployment numbers like we did last week, it's good news for mortgage interest rates. That's exactly what happened. For a lot of people, it happened rather dramatic and rather fast. Rates move every single day, but they move in little tiny increments. They're up, 0.1 or down 0.05. There was a humongous shift all at once. And so I know, because I'm in the business of writing mortgage loans, that my phone was on fire. People looking to refinance where it made sense now. People who were like, you know what? And here's an example, Sean, that people should hear. I talked to somebody who was near the top of their budget. They knew what they wanted to spend on a monthly basis. They knew how much they had for a down payment. And we had kind of talked about it. And the neighborhood they were looking in for a growing family at 800,000, they just couldn't find something that worked. When they called me and said the absolute perfect house came up and it's 860, it felt pretty good for me to say, guess what? That home at 860 with the same down payment that we discussed and all the same numbers from 800, that payment is cheaper than your payment was on 860 last time. Your payment at 860 is cheaper than it was at 800 because of how rates have moved. So, people are going to have lower mortgages compared to the purchase price than they were when rates were higher. They're also going to have more purchasing power, which for a lot of people, that was the problem. I only qualify for 400. This neighborhood I want to move into, entry points 425 or 450. And so it's going to spark a lot of activity in the real estate market. I know it as fact, not because of statistics or any of that, because of real world experience. I see it and feel it in my daily business. And so I'm excited about it because, people have asked for lower interest rates. What I'm not excited about is the dynamics of the market changing and the competitiveness, because if we go too far, too fast, and we don't find some magic cure for, low inventory in a lot of markets, it's going to be competitive. It's going to push prices up, and then it's going to kind of cancel each other out. So that's what's on my mind, buddy.
I've got bad news for you. I think it's going to go too far, too fast.
I might have already done that.
It is on. If it hasn't already, it is certainly on its way. I mean, we can get into this in a second. If anybody's curious about why interest rates go down when the stock market goes down, it's quite, and like, it seems strange that like the way that they're related. But the main reason is, and this has always fascinated me, is that when the stock market goes down, people pull their institutions pull their money out of stocks because they're afraid of volatility. They have to, that's not what you should do necessarily. Like, the way institutions work and the way individuals work, completely different, right? Buy and hold is the best for the individual investor, but institutions have to hedge, and they have to, they have to limit downsides, even if that means limiting upside sometimes as well. But they pull that money out of stocks and they put it into United States treasuries and other bonds, right? They're very safe. They're backed by the full faith and credit of the United States, and are considered the most safe investments on earth, besides maybe like gold or something like that, or real estate. And then as a result of that, the price of those bonds goes up. Because the bonds goes up, those yields, how much the bond pays out per dollar you've invested in them, goes down. So interest rates, in order to, anyway, it goes down. It's fascinating to me how weirdly intertwined all of these things are. But that's not the only reason in this case that interest rates have gone down. It's not just because the stock market has gone down. It's because people think, and are finally right, that the Fed is going to have to respond by lowering interest rates. And when we looked at the chart, oh man, I should have kept the screenshot from last week. When we looked at the chart from last week, you and I were saying, then I guess we're gonna have to eat crow here a little bit. You and I were saying, these people are crazy. 100% of people think that there's going to be a rate cut in September. There is no room in their mind, in the traders' minds, for the fact that the Fed might not lower rates. Well, things have changed a lot since then.
What did they know that we didn't?
Now, not only are traders 100% sure there will be a rate reduction in September, there's two additional things here. One is that there could be two. In fact, most people think that there's a 16 times higher chance of there being two interest rate reductions, or one interest rate reduction worth 2 sort of steps down in September. I mean, how quickly?
88% shot that we're going to get a 50 basis point cut in September. I want to touch on something before I forget that's related to this too, Sean, is we got a comment in the comments, they're telling Jay, and he's referring to Jay Powell, you need to cut ASAP. I even heard people talking about emergency rate cuts, and the Fed has
I know. So I was about to get to it.
In between meetings. I don't think that's going to happen. I don't think they need to, but between now and September 18th, that's a long time. If this trajectory continues at all, the Fed is, I guess based on these statistics too, like likely to do more than 25 basis points, likely to cut 50 basis points. I just want to put that out there for people that like, there's going to be talks of like, there's going to be emergency rate cut, this and that. I don't think it's, we gotta, and Jay Powell doesn't strike me as the guy that's going to freak out and, call an emergency meeting. We'll wait till September, in my opinion.
Can you guess when the last last off cycle Fed rate cut was?
I feel like when there was all those rate cuts in 20, they had to have had some that weren't on meeting.
Good memory. March 15th was the last one.
I remember March 15th. It was like the world was coming to a close, and we had just celebrated my wife's 40th birthday, and we're thinking that we're going to be stranded because we were in Vegas and flights were going to be halted. Yeah.
I was in Mexico, and we like rushed to the border. It took us like 12 hours to get across the border, and took the last flight home. It was crazy. Anyway, so I think to give some context, though, that's helpful because it doesn't feel like global pandemic levels of emergency here. I mean, the stock market losing 5 or 6% over the course of 2 days is not unprecedented. It happens once every year or two. But I think you're right. If we keep going down that path, like they really could be on the table. An emergency rate cut would be pretty big. Like you would have to see today happen and Friday happen a couple times over again before that happened. And I mean, the thing is it's just so reactionary, right? Like it would really channel a sense of panic. Be great for mortgage rates, but it would probably be in the face of like significantly disturbing economic news, which I think like the crazy thing is this reaction is just so over the top. Like our Q2 GDP numbers, 2.9%. Like the economy grew by an annualized rate of 2.9% in the second quarter of this year. Like I get that things are not as good as they were, but they're certainly not like, it doesn't feel like the emergency people are making it out to be. Although,
I don't think we got to pull the emergency brake. I think we tap the brakes and whatnot, and rate cut is finally here, and I think the Fed has what they need to say, okay, a rate cut is justified. But to your point, like it's not a pull the e-brake type of reaction that I think we're going to see or that we need.
Yeah, I agree. Let's go through a couple more of these months because this always fascinates me because I just don't have like the mind of these traders, and I'm right 50% of the time. They're right 50% of the time. But you see a majority chance of there being a second double rate reduction by the November. So again, we skip an October. So we skip an August meeting. We skip an October meeting. God knows why. And there is a long time between now and November. But people foresee a double rate cut between
back-to-back doubles. This is interesting. I haven't seen this yet. So yeah, from 5, the range, which we both agree is kind of silly, 525 to 550 to 425, 450 is 100 basis points in rate cut in 2 meetings. And the favorite current is 50-50. That's interesting.
I agree. And I kind of wonder, like, I think this tool is really helpful, but more and more it's like that expectation doesn't seem priced into the current 10-year into mortgage rates, right? Like they can say that all they want, but when I look at the actual yields on the 10-year, it doesn't really look like people are expecting 100 basis points in a rate reduction. I want to get out of the weeds here a little bit and talk about what this means to you, the consumer, you, the loan officer, you, the real estate agent, here in a second. But let's finish this out. In December, kind of evens out at a fifth down to 125 total basis points in reduction. And then by January, yet another one is sort of the favorite here. So 6 by January. To be fair, people at the beginning of the year, for completely all the wrong reasons, thought there would be 6. Some people thought there would be 6 rate reductions by the end of the year. I don't think anybody quite foresaw it happening like this.
Yeah. Like wait. Oh my gosh. Cut them fast, cut them hard.
Yeah, I mean, for all the criticism of the Fed, for the criticism of like their policy and stuff like that, it's like, Jerome Powell's really stuck between a rock and a hard place here, and I do not envy his position. It's like he would have caught a bunch of flack for lowering earlier. You know what I mean? If he would have done it at the last one, people would have said like, too soon, bro.
Right. Yeah. Now they're gonna say, why 50, why 25? Like
You took too long.
They're gonna question no matter what he does, but. Like you were talking about, I'd love to get into like, what does this mean for the average home buyer? What does this mean for somebody who's, been pre-approved, they've been house shopping? I think it's a double-edged sword, and I already kind of see it because buyers are going to be excited when they get to see, look, this scenario I showed you at 500,000 with a 6.875 interest rate, 6.125 makes the payment look a lot better. But what they're going to find, if they haven't found it already, is that there's no doubt lower mortgage interest rates drive more demand. When you're competing with more people because there's more demand, it's going to be harder. There's going to be homes that come on the market that are in a great neighborhood, they're priced well, and you're going to fall in love. You're going to submit an offer. You're going to get news back that there was 8 offers that the seller had to choose from, and 500 didn't do it. 520 with shortened contingency periods, and the buyer paying rent back to the seller. I've seen it so many times, Sean, that I know it with absolute certainty. Like there's no doubt in my mind because I've just been in the game too long. Like I know what's going to happen. So buyers should be prepared for that. My parting piece of advice on this little rant is get with professionals you like and trust. Real estate agent and loan officer, listen to their advice. If you don't listen and you don't trust them, you're working with the wrong people. Because I've seen too many times somebody look back and go, oh my gosh, that house came up in August. It was perfect. My agent was telling me I should go up to 520. My lender was showing me how we could, buy down the interest rate or do something that made that feel like the payment that we had at 500 that we were comfortable with. But we thought we'd give it a shot at 505. I mean, most often I see like really great advice being given. It's not always listened to on the other side. And quite honestly, sometimes you're not working with the right agent or the right loan officer. Their advice might not be great. And so that's my rant, and I'm sticking to it.
I think it's especially important to make sure you're choosing the right team now with this is its own can of worms. It just does happen to be like some crazy timing. The lawsuit, the National Association of Realtors lawsuit that was found against the National Association of Realtors last year, the changes in the rules about compensation for buyer's agents has changed significantly and goes into effect in just 12 days. So on the 17th, the way buyer's agents are compensated when you want to buy a house is completely different. Now that person isn't paid as a result of the commission that's generated from the sale of the home. They can be paid by things like a concession from the seller, but it's really on the buyer. So, I've heard grumblings about how this is not good and is good. I basically land on the side of like, may not be perfect, but is better for the consumer, because now if you owe that buyer's agent money at the end, right? Like, even if it's coming in the form of concessions from the seller, you're going to be pretty particular about like how good a job they do, right? You used to feel like you were kind of doing the buyer's agent a favor. They were doing you a favor. They were getting paid by somebody else. So like, why would they do what it kind of felt a little like distant. Now it's like, go find people you can work with that are worthy of the dollars you're going to have to pay them. And like more than ever, that agent has to work as a pretty much perfect team with your loan officer, together, even if they don't know each other going into this transaction, like you're going to get a sense for whether or not they're a good team. And they have to be a good team because of the way buyer's agent commissions work and how that affects how we structure the loan. And because like you got to be quick. Like if you see a house on Saturday morning, like you should put an offer in on Saturday. Like it's gonna be things are gonna move quickly. There's gonna be people coming off the sidelines buying in cash or like with close to cash equivalents because they have 50% equity in their house that they've been waiting to sell for interest rates to come down. Like you're gonna be up against like some pretty substantial competition, and you got to know what you're getting yourself into. It has to be very clearly explained to you. You have to make sure that your buyer's agent is vouching for you. You have to make sure that your loan officer is available at, 11:47 a.m. on a Saturday morning to generate a pre-approval, consult with you, make a presentation for you about like, yeah, it's at 520 and we had said 505. It is going to cost you, I don't know, how much extra would that be? Extra $34 a month.
Yeah, seven times 15 approximately from what I've been looking at.
Oh.
So yeah, 105 a month.
I've been out of the game too long.
Yeah, we're between friends,
and
but it's not going to cost. You know what? You're right, Sean. We're gonna buy the interest rate down, and rates have trickled down anyway. So it's really not costing you anything extra per month. It's costing you less per month because the rates are down.
But it is going to have an effect on your cash to close. So a lot of things to consider, and you got to make sure that you have the right team for this. Again, there are so many things changing so quickly, and like this is just the beginning. Like rates are going to be on this downward, as we can see from that chart. It's like people expect, if you go all the way as far as you can on that chart out to like June of 2025, I mean, the target rate is like 275 to 300. Like literally the Fed funds rate is going to be cut in half. Will that mean that current interest rates are cut in half? No, but it would signify 2 to 2.5% drop in rates. So there's not just your current purchase to think about. It's like, where are we going to be in 6 months? Where are we going to be in 12 months? This is not an event. This is the beginning of a new part of the economic cycle, and we've all lived through it several times.
Yep, I agree for sure. I know. I just looked at they've got one for September of 25, and the favorite there is 300 to 325. So 925 basis point cuts from today's current Fed funds rate, which is pretty wild to think about. I'll back up your statement about people should not only be looking at how to structure their mortgage for today, but what should they do? I mean, I've had this conversation so many times where it's tempting to say, oh my gosh, look at, we can get to 599, we can get to 5875 with this much cost. But do you want to spend that now? If like it's very likely those rates are available in the future at little to no cost. You got to consider all of it. And really you got to be talking to somebody you like and trust, because otherwise you're not going to follow their advice if you don't like and trust them. And there's others, myself included, in the mortgage industry that is like, listen, I've wrote 1,400 of these dang things. I kind of have a good idea for what makes sense from a mortgage structure standpoint. And what most great originators do, I think, ones I've been around, is present the options, give you their perspective and some ideas, and then ultimately you're a consumer, you decide. It's your mortgage. But people more often than not, after some of this discussion, and here's some pros, here's some cons, like, Matt, if this was yours, what would you do? And I give that advice as well. Like, based on everything I know about your situation, I'd go with this rate, and here's why.
We got a question here from Jay Homeboy. He says, when buying a home, it is 99% better not to take on any new debt. Good. I'm glad you've been well educated by your loan officer.
There you go.
Is that the same thing when refinancing? I mean, the answer is, basically yes. There is times when I've had a refinance going and the person's like, we need to buy a new car. Like, our car broke down, we need to buy it. And they're going to have a $475 a month payment on the car, and that has a minuscule or doesn't move the needle on their debt to income ratio. And the only pain is, it's like, okay, so we've got this credit pull, so you're gonna have to sign a document why you got the credit pulled. Now you're gonna have to get a copy of the note from the dealer that shows exactly what your monthly payment is. They're gonna have to recalculate the debt to income ratio. So the reason people say don't take on any new debt is because we really want you to really have to for you to do it. So it's not necessarily like, oh, you took on new debt, you can't get a house. It's more like, we don't want you running the calculations about whether it's appropriate or not. So we just really, really discourage it. And then if you have to, it's like, you have to.
Well, and what I see people do, Sean, which is a good idea, talk to your loan officer, because there might be a scenario where you're buying a house and your, ratios are at the very max. If you bought a car, the $475 payment, the deal's dead. There's other scenarios like you talked about where you might be refinancing and you're like, listen, this is going to cause you some more work and you're going to have to provide more documentation, but this, debt to income ratio you have of 31%, you're going to be fine. And so you want to hear that. I mean, I have people, like, what warms my heart more than anything, Sean, is when somebody calls me and they're like, hey, listen, it's going to buy this thing. It costs $475. I'm just going to use cash. Like, is that cool? You guys watching me? Like, if I spend it, and I'm like, thanks for asking. You're going to be fine if you go buy a bike with $400 cash. Like, that's not affecting your credit. But the reason being, for people to know, refinance or purchase, when you get approved, like, it's a snapshot in time of your whole credit profile. Here's how much debt. Here's the new mortgage. Here's your current income levels. And then underwriters look at that and go, yep, you're approved. When that snapshot changes, new debt gets added, that changes, it's going to spark more questions, more paperwork required. And if you're close enough, it might bump you out. I just had a realtor tell me a story about how his buyer, like, killed the deal. And so, it has that potential where if the debt ratio is tight and you slap on a $900 Tesla payment and go, look at this beauty, it's going to look nice in my new driveway, that Tesla is going to be parked at the apartment complex still because you ain't closing.
Yeah, 100%. Also, this goes for literally any financial change. Many of them are fine, but a lot of them come with many of them also are not fine. And they all come with like additional documentation, even up to like taking a new job, especially if there's like variable pay involved. Oh, I'm going to make so much more money commissioned. Now I'm moving from, a base pay at this company to commission to this company. Like, I'm going to make twice as much money. And I'm like, oh, actually, we can't do a mortgage for you for like at least another year, probably 2 years. I've had that happen. The guy calls me like super proud. Is this going to help my rate? And I was like,
you got no rate anymore.
Yeah, your rate is now 0. Yeah, really ruined a lot of days there. And that's on me. You should have a loan officer who is communicating that clearly about making changes in your life. That was an early lesson.
Glad you retired, Sean. I'll make sure these people don't make these same mistakes.
Thank you. Carry on the torch. So, there are untold numbers of effects on you, the consumer, you, the real estate agent, and you, the loan officer, in highly volatile markets. Right there, it is going to be an absolutely bonkers end of the year. And as much as I know you have learned what you think is everything there is to learn about from me and Matt here, Thank you. Where you should really be going for up to the minute information is your local loan officer. I mean, bonus points if they work for UMortgage, double bonus points, kind of like a double fed rate ease if that loan officer is Matt the mortgage guy Gougé. But you should be going with a local loan officer or somebody who's relationship based, referred to you by a real estate agent that you trust, has good reviews. I mean, do your due diligence and make sure that they have your best interest at heart. Make sure you're getting multiple options from them, right? If somebody quotes you a 5.2, we could quote 5.25% on a conventional loan right now. We could quote 4.75 on a VA loan right now, but there are ramifications of that. One being a huge upfront cost, and the second being missing out on the opportunity to reduce your interest rate to that number sometime in the future for close to free or for minimal money. So a lot of things to consider. I think my biggest call to action is find a local loan officer who you trust. Find a real estate agent that's worth their money.
Yeah, I agree. Go to greatmortgagebroker.com if you want to connect with me and my team. I was going to say, I loved everything you said, Sean. For some people, it might be a better option to find the loan officer first, get yourself pre-approved, know the numbers. Most good loan officers know a bunch of great real estate agents. And if you go and meet a real estate agent, they're going to tell you they're the best. They know and love the neighborhood you're looking in. But what I've found is somebody comes to me, here's the neighborhood I'm looking in. I kind of get a feel for that client's kind of style, if they're more analytical or they want someone, who's a, cheerleader in their corner, kind of pumping them up because they want to make this thing happen in 2024, whatever the case may be, I can match them. You know what? You'd be great with Sarah. You'd be great with Doug, whatever the case may be. And so, maybe you start there. I know tons of loan officers that have tried and failed miserably with letting consumers know you can start your home search with a loan officer. You really should. You should know your numbers. You should know you qualify.
100%.
But then you connect with a realtor. I don't think that's been successful. People still start with a real estate agent, but whatever you do, find a great one that's got your back. It's 9:00 my time, Sean. I got to run, but this was fun.
Yeah, this was fun. I can't wait to see what's changed by next week. We'll get some
this week's
predictions
going to be
in.
an exciting one. I guarantee you that.
A tidy one.
Tidy?
Tidy?
Exciting? Tidy?
Oh, exciting.
Yeah.
And
it might be tidy too. I mean, I'll keep my papers tidy. All right. Thanks, buddy.
See you, buddy. Bye, everybody. Thank you.